Last but not least, when we're talking about dilutive securities, we need to talk about earnings per share. This particular video will cover both the basic earnings per share, which you're probably already familiar with, and then the diluted earnings per share as well, which is a result of some of these things we've already spoken about earlier in prior videos in this chapter. So let's start with earnings per share. Earnings per share is something that stockholders and people who might want to invest in an organization are very concerned about. They use it in evaluating the profitability of their potential investment. So the financial press and the analysts really pay attention to this particular type of information. Earnings per share is an indication of the income earned by each share of common stock. Companies report earnings per share only for common stock because remember, they have the residual claim. Earnings per share is indicated on the income statement. And when the income statement contains some of the intermediate components, so discontinued operations, things like that, companies should disclose the earnings per share for each of those various components. A simple capital structure exists when companies have only common stock, or there are no securities that could potentially dilute earnings per share. The basic calculation for earnings per share is net income divided by weighted average number of shares outstanding for a company that has no preferred stock and only has common stock and no dilution. However, often there is a complex structure at play. And that means that there is some type of a security that's around that could dilute the earnings per common share. The word dilutive means the ability to influence EPS in a downward direction. So first, let's talk about if preferred stock is also at an organization. When you have both common and preferred stock, to calculate EPS, you have to subtract the current year's preferred stock dividend from net income in order to arrive at what income could be available to the common stockholders. So you take net income minus preferred dividends divided by the weighted average number of common shares outstanding. Preferred dividends are subtracted on cumulative preferred stock, whether they have been declared or not. Dividends in arrears are not included. If there is a net loss, the preferred dividend is added to the net loss. Weighted average number of shares outstanding refers to the company's weighting of the shares by the fraction of the period of time they are outstanding. If a stock dividend or a split occurs during the year, it's treated as if it occurred at the beginning of the year. If a stock dividend or split occurs after year end, but before the financial statements are issued, the weighted average number of shares is adjusted as if it occurred at the beginning of the year. So let's take a look at Zack Smith Incorporated. Who has these following changes in its common stock during the period. On January 1st, they had a beginning balance of 90,000 shares outstanding. They issued an additional 30,000 in April for a total of 120,000 shares outstanding. They repurchased into treasury stock 39,000 shares, leaving 81,000 outstanding, and then issued another 60,000 shares for cash. This gave them a balance of 141,000 shares. We're going to compute the weighted average number of shares outstanding for Zach Smith Incorporated. Now here we have split the screen, and you see at the top we have all of the changes line by line. We move that into a table or into an Excel spreadsheet, and we show what our dates are for outstanding and how many shares were outstanding for that period. We multiply it by what that period is. So January 1st through April 1st is 3 out of 12 months. So it's 3/12. We multiply the number of shares by the fraction of year to determine what the weighted shares were. We do this for every time we had a change. So from April 1st to July 1st, there were 120,000 shares that were outstanding. That is for a period of 3 out of 12 months, which resulted in 30,000 weighted shares. Continuing on all the way to December 31st, in which there were 141,000 shares that were outstanding between November 1st and December 31st, which is a fraction of 2 out of 12 months. That means that there were weighted shares for that period of 23,500, giving us a total weighted average number of shares throughout the year of 103,000 shares. So this is how we calculate for the number of weighted average common shares that we'll use in our EPS calculations. Here we have Bergman Company with these following changes during its stock during the period. I want you to just take a minute, hit pause, and go ahead and begin the calculation using what we showed and what we have shared in prior slides. So using this information, you should have created your table, A, B, C, D, as we show here. So we start with January 1st through March 1st because we had a steady 100,000 shares that were available during that period. We multiply it by restatement of 1.5, and that is because we have the 50% stock dividend that came into play in June 1st. Remember, we act like it began at the beginning of the year. And then we have the fraction of the year, 2 out of 12 months. When we multiply those three, we get 25,000 shares. There were 20,000 shares issued. Again, we restate it at 1.5 because of the stock dividend that occurred on June 1st. That is 3 out of 12 months, resulting in 45,000 weighted shares. Now, from June 1st through November 1st, there were 180,000 shares. There's no restatement or readjustment here because this is point after the stock dividend has occurred. And that is a period of 5 out of 12 months. Then November 1st through December 31st, there were 210,000 shares for 35,000 weighted shares and a total of 180,000. Now we've illustrated to you the basic weighted average shares outstanding, illustrated how to deal with something like a stock dividend or a stock split. Remember, we act like it goes back to the beginning of the year. Now we're going to talk about diluted earnings per share. Complex capital structures exist when a company has convertible securities options, warrants, and other rights that upon conversion or exercising could dilute earnings per share. There is a need to present both your basic and your diluted earnings per share on the face of the income statement. Most of you have looked at an income statement by now and have probably noticed that there are two EPS values. We've already talked about how the first is calculated. Now we're going to talk about how we go about calculating for the second and what some of the problems are related to this. When we think about diluted EPS, the diluted EPS calculation includes the effect of all the potential dilutive common shares that were outstanding during the period. So it starts with basic EPS and then takes into consideration the impact of convertibles and the impact of options, warrants, and other dilutive securities that are present at that point in time. Companies won't report their diluted EPS if the securities in their capital structure are anti-dilutive. So to start with, let's talk about the impact of convertible securities. Convertible securities, such as convertible bonds. Convertible securities, in the measure of the dilutive effects of their potential upon conversion on EPS, is done using the if converted method. The conversion is treated as if it occurred at the beginning of the year or at its issuance date if it was issued during the year. The weighted average number of shares outstanding in the denominator is increased. And related interest expenses net of tax is eliminated from the numerator. Let's take a look at Mayfield Corporation, who has net income of $210,000 for the year and a weighted average number of common shares outstanding during the period of 100,000 shares. The company has two convertible debenture bond issues that are outstanding. One is a 6% issue sold at 100, so a total of $1 million in a prior year, and is convertible into 20,000 common shares. The interest expense on the 6% convertibles is 60%. The other is a 10% issue sold at 100, total $1 million, on April 1st of the current year, and convertible into 32,000 common shares. The interest expense on the 10% convertible bond is $75,000. The tax rate is 40%. So basically what we're going to begin doing is we're going to begin assuming if these were not actual bonds and had converted to their 20,000 and 32,000 common shares, what would the effect have been? What would it have been on net income, and what would it have been on weighted average number of common shares outstanding for the period? So we calculate basic earnings per share to begin with. That's net income of $210,000 divided by the weighted average shares of 100,000, which gives us $2.10. We then need to go and we need to calculate weighted average number of shares outstanding for dilutive securities. So we had 100,000 to begin with, and then the shares that would have assumed to have been issued were 20,000, and as of date of issue, so we take the 32,000 when we multiply it by 9 out of 12, because remember there was that second issue in this particular year, so that would have been 24,000 weighted average, gives us a total of 144,000. Now we're going to calculate diluted earnings per share. We start with the basic EPS of 210. And then we add 60,000 multiplied by 1 minus 0.40. That's our interest expense and its tax effect. And we add the 20,000 shares because that was already outstanding for the entire year, or would have been considered outstanding for the entire year. That means that we would have had a $1.80 effect on EPS. Then we add 100,000. That's the multiplied by 1 minus 0.40 multiplied by 9 divided by 12 time frame to account for the issue that occurred in April. 100,000 in expense, undo the tax effect, and apply it only for the period in which it existed. And the 24,000 weighted average shares as a result of that, not the full 32,000 if it converted, because that would be if it is being applied to the entire year, for an effect on EPS of $1.875. This means that our diluted EPS is $2.02. So some other things that may happen. The conversion rate on a dilutive security may change during the period in which the security is outstanding. In this situation, the company uses the most dilutive conversion rate available. This is in accordance with the principle of conservatism, where we want to provide more or less the worst case scenario. So for convertible preferred stock, the company does not subtract preferred dividends from net income in computing the numerator. And the reason for that is that for purposes of computing EPS, it assumes conversion of the convertible preferreds to outstanding common shares. So we don't have to remove the dividends because we are taking the stance that they would have converted. So let's look at Cherick Enterprises, who issued at par 60 $1,000 8% bonds, each convertible into 100 shares of common stock. Cherick had revenues of $17,500 and expenses other than interest and taxes of $8,400 for 2017. They ask us to assume that the tax rate is 40%. Throughout 2017, 2,000 shares of common stock were outstanding, and none of the bonds were converted or redeemed. We're going to compute diluted earnings per share for 2017. Assuming the same facts as those for Part A, we're going to except for the 60 bonds were issued on September 1st, 2017 rather than 2016, and none of them have been converted or redeemed. So for the first one, let's start with net income. So we had revenues of $17,500 and expenses of $8,400. There was bond interest expense, 60 times 1,000 times 8% of $4,800. Income before taxes was $4,300, and our income tax expense at a rate of 40% was $1,740, giving us net income of $2,580. Continuing to move forward, now that we have a net income, we're going to calculate for basic EPS. Net income is $2,580, and we divide it by weighted average shares of 2,000 for basic EPS of $1.29. So we go into the extended version to calculate diluted EPS, starting with net income and 2,000 weighted average shares and basic EPS of 129, which we just calculated. Now we need to add back the interest expense of 4,800 multiplied by 1 minus 0.40 so that we can negate the tax effect. And add the 6,000 shares, the assumption of conversion at the beginning of the year. We have an effect on EPS of 48 cents. Our total is now 5,460 divided by 8,000, or 68 cents for diluted EPS. Now, this is for a bond issue that was already in place, soon to be in play for the entire year. Now, if we assume that those bonds were issued on September 1st, 2017, rather than September 1st, 2016, the calculation for net income is going to be slightly different because it won't be an entire year's worth of bond interest. So instead of 4,800, it's 1,600. We start with our dilute. We start with 4,500 divided by 2,000, or basic EPS at $2.25. We add back the 1,600 in interest expense multiplied by 1 minus 0.40 for us to negate the tax effect. And then we do the weighted shares. So 6,000 shares multiplied by 4 out of 12 to give us an effect on EPS of 48 cents. When we do the math all the way across, we get 5,460 is what net income would have been. And shares of 4,000. And a diluted EPS of $1.37. Remember, we use the if converted method. So if it's already been at play in the entire year, we expect the entire year. If the issue is in the year, then we go from that point forward and we do weighted shares based off the time that they would have been converted. So I'm going to go ahead and give you one more example. Here we have Barclay. Prior to 2017, they had issued 40,000 shares as 6% convertible cumulative preferred stock, $100 par value. Each share is convertible into 5 shares of common stock. Net income for 2017 was $1.2 million, and there were 600,000 shares of common stock outstanding during 2017. There are no changes during 2017 in the number of common or preferred shares outstanding. I want you to hit pause and leave this up so that you can access this information, and I want you to compute the diluted earnings per share for 2017. Once you have done that, remember, start with basic EPS and then move into diluted EPS. Then I want you to restart the video from this point. Okay, so you should now have restarted the video after having done the computations for diluted earnings per share. We'll walk through this and you can confirm if you have all of the steps or if there's something you missed, and we'll we'll illustrate all of them here. So really it is just taking and doing every single piece step by step. The first is to calculate basic EPS. Now we have preferred dividends. This is preferred stock, right? So we start with net income of $1.2 million less the preferred dividends at $240,000. That's calculated from 40,000 shares multiplied by $100 par multiplied by 6%, and that gives us the $240,000 preferred dividend. Remember that preferred stock is issued with a percentage of par, defining what that dividend is usually. We divide it by the weighted average shares of 600,000, and you should have basic EPS of $1.60. If you forgot, for example, the preferred dividend component or miscalculated the $240,000, I want you to go ahead and hit pause right now, fix that part of your equation, and recalculate your diluted EPS. If you had a pause, you should be restarting about now, and we'll continue to move forward into the conversion for the if converted method. So let's look at that. If the preferred stock had converted to common stock, think about that. If it had converted, there would have been no need for preferred dividends. So we add the preferred dividends back. Then we represent 200,000 additional shares. That's the 40,000 multiplied by 5 because they're convertible to 5 shares per. And that gives us an effect on EPS of $1.20. When we carry the math across, so we're back to 1.2 million of net income, and we divide it by 800,000, that gives us diluted EPS of $1.50. If there's one part of this that you missed, I want you to go back and read the problem and think about the nature of preferred stock. Now, sometimes our preferred stock is going to be 5 shares. Sometimes it's going to be 2 shares. Sometimes it's going to be 9 shares. It really depends upon what is attached. So let's look at the same situation. If the preferred stock was convertible into 3 shares of common stock, we'd still add back the $240,000 because the dividend rate was no different. We're only changing the number of shares of common stock. So instead of 200,000, we're at 120,000. 40,000 times 3. Still have the 1.2 million in net income. And then we divide that by 720,000 weighted average shares outstanding, giving us $1.67 in diluted EPS. Next, we're going to talk a little bit about options and warrants. So, options and warrants. With options and warrants, we use the treasury stock method. This is a measure for the dilutive effects of the potential conversion that's a little bit different. The assumption is that the exercise occurs at the beginning of the year or the issue date if it's issued during the year. The proceeds are used to purchase common stock for the treasury, at the average market price for common stock during the year. If the exercise price is less than the market price of stock, dilution will occur. If the exercise price is greater than the market price, securities are anti-dilutive and can be ignored in the diluted EPS calculation. Contingent shares are included in the computation of diluted EPS. And convertible options, warrants, and contingently issuable shares are included in EPS only if they are dilutive, meaning they would reduce EPS. Anti-dilutive securities are ignored for the purposes of computing EPS. So let's look at an illustration of Zambrano Company. Zambrano Company's net income for 2017 is $40,000. The only potential dilutive securities outstanding were 1,000 options that were issued during 2016, each exercisable for 1 share at $8. None has been exercised, and the 10,000 shares of common were outstanding during 2017. The average market price of the stock during 2017 was $20. We're going to use the treasury stock method to compute diluted earnings per share for Part A. And then for Part B, we're going to assume the 1,000 options were issued in October of 2017 rather than in 2016. And that the average market price during the last 3 months of 2017 was $20. So we're doing one for the entire period, and then we're going to do one as if it happened during the year. So with the treasury stock method, we start with the proceeds if the shares were issued. Now that was 1,000 shares, and they had an $8 attachment to them. So that's $8,000. If that was used to invest for treasury shares, we divide that by 20 because that's the current market value, meaning that we would have purchased 400 shares. There were 1,000 shares issued, giving an incremental share increase of 600 shares. Now that we have a share to work off of, we have to compute the diluted earnings per share for 2017. So let's follow the general diluted earnings per share logic. We begin with basic EPS, 40,000 divided by 10,000, and basic EPS is $4. Then we add the 600 incremental increase from the options, which gives us 40,000 in net income divided by 10,600 shares if they had all been exercised. That is $3.77 of basic EPS. Now we're going to compute the diluted earnings per share, assuming the 1,000 share options were issued on October 1st, 2017. The proceeds would be the same. It would be $88,000, assuming shares purchased of 400. We issued 1,000, so the incremental share is still 600. However, we have to weight that for 3 out of 12 months. That means the weighted incremental share increase is 150. When we change the options to 150, we now have $40,000 divided by 10,150 for diluted EPS of $3.94. Contingent issue agreements. Contingent shares are issued as the result of passage of time or condition, upon attainment of certain earnings or a market price level. Remember, if there is something that is anti-dilutive, if it's an anti-dilutive security, we will ignore that in all our computations of calculating diluted earnings per share. Now we'll begin talking about some of the things that you need to know about the presentation of EPS and the disclosure of EPS. As with anything else that deals with accounting, there's a lot of disclosures and presentation that are required. So EPS is presented for a variety of things. There is for continuing operations, income before some extraordinary items, things like discontinued operations and net income. And per share amounts for discontinued operations or an extraordinary item should be presented on the face of the income statement or in the notes to the income statement. Prior period EPS is restated for any prior period adjustments. EPS is presented for all periods that are presented. And additional EPS disclosures are required in notes for companies with complex capital structures and dual presentation of EPS. Some of this is illustrated here. For example, in note form, you're going to find descriptions of the pertinent rights and privileges of the various securities that are outstanding, a reconciliation of the numerators and the denominators of the basic and the diluted per share computation, including individual income and share amount effects of all securities that affect EPS. The effect given preferred dividends in determining income available to common stockholders in computing basic EPS, and securities that could potentially dilute basic EPS in the future that were excluded in the computation because they would be anti-dilutive at this time. The effect of conversions subsequent to year end, but before issuing the statements. I want you to think about that last one for a minute. Subsequent to year end, which means that the year has passed, and in that period of time before the financial statements are created, there has been a conversion. That also needs to be disclosed. Remember, not only do the notes impact what happened in that year, sometimes they have some additional information about things that have happened before the financial statements were issued. So a quick summary of EPS computation. We have our simple capital structure and how to compute the income applicable to the common stockholders. Net income minus preferred dividends, and then we divide that by the weighted average number of shares outstanding. We've illustrated how to calculate that based upon several potential situations. The simple capital structure is, of course, the one that we prefer if we're having to do calculations. Unfortunately, it's not what is usually in place because of options, warrants, and other potential things such as convertible bonds or preferred stock. The complex capital structure comes into play. With the complex capital structure, we begin by calculating our basic earnings per share, and then taking into account the effect of the various dilutive securities that there are. We take our income that's applicable to common stock and adjust it for interest net of tax and preferred dividends on all of the dilutive securities. We divide that by the weighted average number of shares, assuming maximum dilution from all dilutive securities. So if an issue is already in place, we assume that it was all converted. If an issue occurs partially through the year, we go from that date forward and we weight it based off the time that it would have been present. Now that we have talked about dilutive securities and the different aspects of dilutive securities and how they're accounted for, and also now how we would disclose their effect to the users of the financial statements, most especially to our current shareholders and the potential investors, so that they have clear information to make decisions on whether or not to invest or continue to invest in our organization.